The richest 1% pay an effective tax rate of just 23%. The middle class pays 25 to 30%. That's not a typo. The rich legally pay less tax than you. And it's because of 5 loopholes that are completely legal. Let me break each one down. Loophole number 1. Long-term capital gains. If you earn $100,000 as a salary, you pay up to 40% tax. But if you make $100,000 selling stocks you held for more than a year, you pay just 20%. That's half the tax. For the exact same amount of money. The rich don't work for salaries. They work for capital gains. Look at this chart. On the left, a doctor earning $150,000 paying 40% tax. That's $60,000 in tax. On the right, an investor making the same amount from stock sales. Just $30,000 in tax. That's a $30,000 difference every single year. Over 20 years, that's $600,000 kept, simply by earning through capital gains instead of salary. Loophole number 2. The step-up in basis. This is the most powerful wealth transfer tool in the tax code. Say you buy shares for $10,000. They grow to $1 million over 40 years. If you sell, you'd owe tax on $990,000 of gains. But if you die and leave those shares to your children, they get a step up in basis. The cost basis resets to $1 million. They can sell immediately and owe zero tax. $990,000 in gains. Completely tax-free. This chart shows how the step-up in basis works. The green line is the growing value of the investment over 40 years. The red dashed line shows the cost basis staying flat at $10,000. Without the step-up, the entire gap between those lines is taxable. With the step-up, the basis jumps to the full value at death. The gap disappears. This is why the wealthiest families hold assets until death. They never sell. They never pay tax. Loophole number 3. Real estate depreciation. This is the loophole that makes real estate the ultimate tax shelter. When you buy a rental property, the IRS lets you deduct the building value as a depreciation expense every year, even though the property is probably going up in value. So you get a tax loss on paper while the property actually gains value. This is called phantom depreciation, and it can wipe out your rental income entirely on your tax return. This chart shows the genius of depreciation. The green line is your actual property value rising over time. The red bars are your tax deductions from depreciation. Your property goes up. Your taxes go down. You're making money in 2 directions. And when you eventually sell, you can do a 1031 exchange to defer all the gains. The rich buy properties, depreciate them for decades, then swap into bigger properties without ever paying tax. Loophole number 4. The backdoor Roth IRA. There's a limit on how much you can put into a Roth IRA each year. $7,000 if you're under 50. But there's no limit on how much you can convert from a traditional IRA to a Roth. So wealthy investors contribute to a traditional IRA, then immediately convert it to a Roth. It's called the backdoor. All future growth is completely tax-free. Forever. Look at the power of tax-free growth. If you put $7,000 a year into a Roth for 30 years at 10% average return, you'd have over $1 million. All completely tax-free when you withdraw. Compare that to a regular investment account. Same contributions, same returns. But you owe capital gains tax on everything above your contributions. That's over $200,000 in taxes you avoid. The backdoor Roth is the single most powerful wealth-building tool available to ordinary people. Loophole number 5. Donor-advised funds. This one is counterintuitive. You give money away and save on taxes. Here's how it works. You donate appreciated stocks directly to a donor-advised fund. You get an immediate tax deduction for the full market value. The charity sells the stock tax-free. You never pay capital gains on the appreciation. And you get to recommend which charities receive the money. The rich use this to dump their worst-performing stocks while claiming the deduction at full value. This chart shows the double benefit. You donate stock worth $50,000 that you bought for $10,000. Without the fund, selling would cost you $8,000 in capital gains tax. With the donor-advised fund, you get a $50,000 deduction, saving you $20,000 in income tax. You avoid $8,000 in capital gains tax. That's $28,000 in total tax savings. And the charity gets the full $50,000. Everyone wins, except the taxman. Here's the summary. The rich pay less tax because they play a different game. They earn through capital gains instead of salary. They hold assets until death for the step-up in basis. They use real estate depreciation to create paper losses. They shelter growth in Roth accounts. And they donate appreciated assets for double tax benefits. None of this is illegal. It's all in the tax code. The question is whether you're using it. If you found this useful, drop a like and subscribe. These strategies are available to everyone, not just the wealthy. The difference is knowledge. Start with one strategy this year. The Backdoor Roth is the easiest to set up, and it gives you decades of tax-free growth. I'll see you in the next one.